Okay. So does anyone know the movie Weekend at Bernie's?
Yeah.
Okay, so we were concerned that some people might not get the reference, but Biden's like sort of dead from the shoulders up now. And I just think, and Steve disagrees with me, but I think he's about the worst president we've ever had. Now, I have a policy that I really respect anyone who will get into that office. And I say I might have policies and views that are different than theirs, but you have to respect someone who gets to that position. But I do think he's about the worst president that we've had, and I think he's just beyond it. And I think it's a real serious problem. So we did call this weekend at Biden's, and I am critical of the president, which I normally am not. I normally say we have to deal with the policies that they throw at us and invest based on the policies they throw at us. But right now, what we're looking at are policies that are very ill-conceived. Okay, so now the market, of course, has been falling in the last quarter, and we have not seen earnings estimates going down. So people are selling the rumor, and I'm expecting that when the earnings come out, there's going to be some pretty severe disappointments, but the stocks could rise on the bad news because that bad news is already baked in. So even though earnings estimates haven't come down, the stocks have. It's kind of looking like oil stocks. They're going the opposite direction of earnings, the stock prices, and now they're starting to catch up. So it takes a while sometimes for earnings estimates to catch up. So we have 14 now. 14. So our mission is to help Australians diversify into sectors of the economy that you can't get locally. So you can get banks and resources, but you can't buy aerospace and defense, you can't buy IT, you can't buy cars, and the whole food, consumer products, et cetera. So we try and help you invest where you consume things, but you can't get that on the Australian market by offering US dollars. Now, I put the general advice in smaller print today because it is small print. The market down 8% for the month. Earnings estimates fell 0.1%. One of the things that went down a lot was Micron Technology, because they provided a warning in the semiconductor space. But we do have earnings estimates still higher for oil companies, but we saw oil down 10% last night. So that's going to turn around. But one of the things holding up those earnings estimates this quarter and this month in particular were the strength in the earnings from the oil stocks. And that brings a PE down to 15. So 15 sounds really, really cheap. But Chris, I'm going to call on you early, just to remind people what the envelope of sensitivity is and the comparison to the 10-year bond. Because right now we have a 10-year that fell back from 3.5 to 2.9 yield on the 10-year.
Yeah, so the concept of theory is that in equilibrium, the earnings yield should equate to the 10-year bond yield. But that relationship sort of really only holds within, say, a 5 to 10% 10-year bond yield range. And so as we've seen, 10-year yields come well below 5%, we never really saw price earnings ratios expand beyond the 20, which is 20 times, which is the inverse of a 5% earnings yield. And similarly, as rates start to normalize and we approach that envelope of sensitivity again, we're not anticipating the rate rises to be a headwind to equity valuations. But that is something that we've seen, perhaps driven by rates, also inflation, and other sort of macro concerns which have fed into the multiple compression, particularly for the higher growth stocks.
PE multiples. Okay. So
Can I just ask a question? That change in the 10-year yield, 3.5.
yeah,
When was that peak?
a month ago.
Mid-month.
Yeah.
Wow.
Yeah.
Oh, no, during the month it rose to 3.5. Yeah, so during the
high,
month,
yes.
and it settled back to 2.9. So below 3, with the yield coming down substantially, what I said, and you'll read it in the newspaper overnight, but what I said on Sunday, the first place you heard it was the Fed's next move is to cut rates, not to raise rates. Right? And what?
Yeah, it's a big call.
Oh yeah, and
It is a big call.
I'm there's
It's not consensus.
so it's not consensus.
But that's
no,
what bond investors are saying. That they are pricing in a recession. That's a pretty dramatic change in the 10-year yield. And for the third time, I think last night we saw inversion again inversion in the 2 to 10 year yield curve, which historically has been a signal of anticipated recession, which I mean when the numbers are crunched after the fact, I think it'll prove that we're in the recession now, according to the technical definition.
Now, we did the pig and the python last month. So does everyone remember the pig and the python? So the pig and the python refers to the baby boom generation in America being a very large group of people that are going through the system and causing, an expansion and then eventual contraction when they retire and then et cetera. So I refer to Biden's $1.9 trillion rescue package, which is now about 15 months old, as a pig in the python in the American economy, because he's borrowed 1.9 trillion and he spent it. And by borrowing 1.9 trillion, I'll go into more math on this, but it causes a sugar high or a bunch of expenditures which are now worn off. And those expenditures caused inflation, which is now wearing off very quickly. So I think that what America is going to end up with is 1.9 trillion in debt, and they'll have had a sugar high and it'll be gone. So I think that Biden's rescue package is a mini pig in the python, but it's a disaster. And I've been saying that all along. Now, what happened is that the Fed should have raised interest rates when Biden said he was going to borrow $1.9 trillion to counteract the effect of him spending all this money. But, they didn't. They waited a year. So what you have is this timing differential where you spend, the government spends the money, people spend the money, and it's been spent and you have the inflation, and now the Fed's coming in to raise interest rates to try and slow an economy when it's naturally just about to fall off anyway. So there's a horrible timing issue going on, which is causing this weakness in the market and will potentially continue to cause weakness in the market. And that's why one of our stocks is Activision, of course. So that pig in the python and that timing issue is an important thing to understand right now in the economy, because it also causes a lot of disruptions because people have to move around and change and do things differently. And it became most obvious on, was it Friday or Thursday, when Micron Technology reported their earnings, and we're going to go into some detail on that. The volatility is also up. It got as high as 36 and finished at 26. The volatility index is, well, Steve, do you want to explain how the volatility index is calculated?
Sure, yeah. So it's essentially a measure of forward option prices and as premiums on options expand, that affects the index to the upside and vice versa. So it's a measure of future option premiums, which gives you a sense of what investors are expecting, but it's a highly volatile index.
In the global financial crisis, when there was a lot of uncertainty, the VIX went to 80 and went to 40 to 40 to 30, and then now we're up as high as 30 again, which implies that there's a lot of uncertainty going on at 36. An average would be around 20 or below, so down to 15. The Fed's next move is to cut rates. The bottom-up analysis, stocks were sold down in anticipation of a bad earnings season. Some stocks will rise on after reporting disappointing earnings. So a company will say, we're supposed to make $1, we made 90 cents, and the stock goes up. Okay, so don't be surprised to see that.
It's a question.
Can't hear Steve. Oh. So when you speak, we'll just switch sides, okay? So you're closer to the mic. Okay. Oh, we have 20 people now. That's better. So we do have some big changes going on. So the oil price is up and then down 10% last night. We have higher labor costs, which are considered to be sticky, higher petroleum or oil costs. Money is more expensive, supply chain disruptions. So there could be a lot of uncertainty in this next 3 weeks as earnings come out in the next 3 weeks, right? Alcoa will be first, and Alcoa's had a really good run, and they're on the crash side now. But because Russia's out of the market and they're the biggest aluminum maker in the world, they could do really well. It's really hard to tell how they're going to go, how Alcoa is going to go. The biggest movers in the market, Alibaba was up 24%, Air China, Coty. Now, Kelly, why is Coty up so much? You
Well,
gotta
quite-
switch sides, yeah.
Well, as we know, Coty, they manufacture and distribute beauty products such as Maybelline and CoverGirl. They have a market cap of about $10 billion. And their business focus has always been on mass market products. But over the last few years, we have seen a transition into more of the luxury, higher end brands and the social media driven brands. And that's reflected by the investment in Kim Kardashian West, her beauty line. So they took a 20% stake in that. And then on top, in addition to that, they did take a 50% stake in Kylie Jenner, which is a stepsister of Kim Kardashian, in her beauty line. And since then, surprisingly, they have been performing very well, and this was reflected in their earnings results last month. And also, in addition to that, Citigroup came out with an upgrade to a buy with a price target of $10. So that's helped drive.
Sorry. Is this the monthly movement or the half
This
year?
is from the last report a month ago. So
1
usually,
month.
we do the reports at the weekend closest to the end of the month. So that might be 4 or in some cases 5 weeks.
What's driving Alibaba?
It's recovery in China. So Alibaba and Baidu have been under a lot of pressure, and it's a relief trade out of China. But they did report earnings, which beat substantially, and we roll forward to the next year's earnings. So they did have a good earnings announcement, and there's good fundamental underlying business there. But what we've learned in China in the last few years, I think John will probably help us understand this, is that these companies are more vulnerable to changes in policy than some of the U.S. counterparts are. And when you look at the FANG stocks, they're susceptible to U.S. government policy, but apparently the Chinese companies are more exposed to a change in policy.
Very diplomatic.
Well, I think that's correct. Am I getting
Oh,
it
yeah,
wrong?
absolutely.
Am I getting it wrong, John? Am I getting that wrong?
You're right. You're right. You're right.
But if you look at the U.S. system of changing a policy, you have idiots. Like
Tell us what you really think.
like Pocahontas. Does everyone know who Pocahontas is? Elizabeth Warren out there saying that no mergers above $5 billion should be allowed. And then she gets watered down dramatically. But, having a single party, sorry, I'm pointing at you, John. How long have you been here in Australia?
7 years.
About 7 years. Okay. And so, but you learned most of your economics while you lived in China, right? So, okay. So, with a single party system, you're more efficient and rolling out a policy very quickly and influencing companies. So it just shows the vulnerability of some of these Chinese companies, but those have come back now in Alibaba and Baidu, which is nice. Boeing had a little recovery, better than the 8% fall in the market. Some food companies and consumer products companies did quite well also. So Colgate and Hershey. On the downside, I really agree with Credit Suisse that Carnival and Royal Caribbean are probably going to go bankrupt. Now, if I look around this room and who was here last month and the month before, it's nice to see you here, nobody wearing masks and nobody checking in, and we're a bit more relaxed. But a lot of people are not going to go on cruises anymore because there's just such a big group of people, and the vulnerability of why would I be stuck on a cruise ship and end up potentially locked up offshore. So there's so much debt. So think of a cruise ship as a floating hotel with a huge amount of fixed costs and very low variable costs. And if they can't sell that ship then and keep the revenue coming through, they go bankrupt pretty quick. So I think they're more likely to go bankrupt than to survive. And I'm not going on a cruise. Matt, are you going on a cruise? No, that's not going on a cruise. Okay. So downside, surprisingly, Alcoa, we're going to talk about Western Digital. They really got caught up in the Micron technology stuff. Block, they bought a company in Australia called Afterpay, which I think, you know what I think, right? What do I think? What do I think of Afterpay?
It's never going to work.
I think it's a disgusting, dirty business. It's really what it really is credit cards without having a percentage of write-offs and without credit checks.
13.9% is their bad debt ratio.
It's really a filthy business. To me, it's kind of like those payday lenders. It's just an ugly business. Now, I remember my friend Nick Davies, who has done software for the banks and credit stuff, and he was telling me, "Oh, this great new business." I said, "Sounds really, really dirty to me." And so block buying them was a bad idea, and I wouldn't be surprised to see them continue to go down because Block is now doing. So does everyone know who Block is? Okay, so someone explain Block for
So
me.
Block changed its name from Square, and they're essentially Square
Because they got
is a,
involved in the blockchain business, right?
Yeah.
But their square was a little white square.
yeah, and you see them at vendors all over Melbourne. It's a very inexpensive and efficient way for small businesses to charge credit cards, and it's very effective. They've gained an enormous amount of market share against some of the traditional mainline credit card processors. But it's basically a credit card processing business, and they take a little clip on every sale. And they've now expanded into more of the credit side of things by acquiring Afterpay. But they paid all stock, so it wasn't, a terrible.
The square thing, you plug it into your phone and you carry it around to the stalls at the. So that was a good business and very expensive, but buying Afterpay was a bad idea. Applied Materials down, Micron down. So we're going to see a lot more weakness in the semiconductor stocks, and we're seeing some turnover in the oil stocks. So Marathon and Devon, they're the Permian Basin companies. So remember, about 4 years ago, we had a lot of fracking going on, and those companies with deep oil in the bedrock would frack the rock, and those are Devon, Oxy, Marathon, and Devon, Oxy, and Marathon, basically, right? So we can see here a lot of weakness in oil and metals, which have been strong. Weakness in financials, very weak in semiconductors, and those stocks with very little cyclicality over your consumer products, food, pharmaceuticals, all doing okay. The FANG stocks were up and down and doing okay, and aerospace and defense was okay. But the weakness in the cyclical end of the market, as we're seeing now that there's a likely recession, right? And earnings estimates, we see these are roll forward. So this is the changes in earnings estimates. Micron, a 40% reduction in forecasted earnings for next year. Carnival down, and the home builders all down very significantly. So a rising interest rate environment and an overbuilt U.S. housing market is resulting in some real serious downturns. But there's also supply chain problems because they can't get the plastic that they need. So plastic goes, the oil goes up, plastic goes up, and you can't get the window or whatever. So real tough period for the housing stocks. I'd be careful of them. On the upside, Spotify had, well, Chris, you were talking about Spotify. Do you want to talk about? I mean, we're going to come back to this later and we'll skip it later.
Well, in this inflationary environment, a lot of the subscription business models are experiencing higher churn rates from customers. So I guess as consumers take the ruler over their expenditures, they are churning more. However, Spotify is bucking the trend, and they have consistently reduced their churn rate. And they disclosed this down to about 3.8% at an investor day, which they hosted earlier in the month. And so it looks like their strategy's working. They're trying to differentiate themselves versus competitors with unique content. As I like to say, a song's a song, but they've invested in unique differentiated content in the form of podcasts. So that's driving their user engagement and lower churn at a time when a lot of other subscription services are seeing churn rise. So that was well received, and the analysts incorporated that insight from the investor day into their earnings estimates.
We also have earnings estimates going up for Devon, Marathon, Exxon, and Apache, and Texaco. So all the oil stocks, we still see earnings estimates still going up, but the stock prices are going down because the earnings estimates are trailing the stock price. So they had to raise them last month, but they're going to have to be reduced this month. And so there's a lot of volatility in the oil sector there. And this means that they rolled forward to a new year. So FedEx has a different year end. So they reported earnings, and the earnings estimates are up because we're looking at May 24 instead of May 23. Right? On the top down, we see GDP fell in the first quarter. That's versus a 6% increase in the fourth quarter. So what we saw in the first quarter is a fall. What we're likely to see in the second quarter is a continued fall. And we get more current data on prices. So we see the components of the GDP last year is a $23 trillion GDP. So you add about 2 trillion from the rescue package, the sugar package, I should call it. The components are the US domestic product 23, personal consumption expenditures, about 2/3 of overall expenditures, the government at about 4 billion, and then government consumption expenditures 4. So that's the breakdown. It's a very consumer focused economy. And the changes are that utilities went up in the first quarter and education went up. So you've got a higher cost of electricity, a higher cost of heating, and you have people returning to the classroom. But on the downside, the downward changes of that 1.9% contraction is a 24% reduction in mining, which will affect Caterpillar, right? Yeah, so non-durable goods, retail, food and accommodation are down. So these are the downward sectors. So when you have a higher oil price and people are spending more money at the pump, they're going to spend less on accommodation and food. They're going to spend less on retail. So there's a substitution thing going on there where people are spending more on gas and less on other stuff. I went and filled up my motorcycle the other day at usually it's about $20. I mean, you all have the same experience. $35 for my motorcycle. And I said, is that the right receipt? No, I'm at pump number 2. I was genuinely shocked by it. But in the first quarter, the price, I always get it wrong. The personal consumption expenditure price is led up by healthcare. So volumes must be down. So if you've got a 7% increase in prices and GDP is down, you must have a big fall in the volume, right? So, and government is stable at 2. So if you've got, so that all applies to about 2/3 of the economy. And just to do a comparison, so you can see how New York, as opposed to California, California is probably the exact opposite of this, but in New York, you have financial services being about 30% and other professional services being about 14%, but the government's only 10%, whereas about 16 or 17% in other, in the overall economy of the United States. So some states are more bureaucratic and some are less. In the second quarter, we continue to see prices going up, and we've got a negative estimate for the GDP, which means, again, volumes must have dropped dramatically. And the vulnerable this quarter, the real vulnerability is going to be in, again, the retail, the accommodation, the travel, and the durable goods, right? So non-durables will be less volatile, but fewer washing machines for new homes. So less spent there. So gas will be a substitute for food, travel, and entertainment. The US government debt is up to $29 trillion. I mean, that, as you know, that frightens the heck out of me. And, you know, we have very expensive rent here, but they can't get the air conditioning working in this building, and they never have since we worked here. And it's hot, right? Is it just me getting hot? So I call it Biden's sugar high, but really Biden's sleep at the wheel, or, you know, I mean, I wanted to put it, somebody, Natalie sent me a picture of, you know, weekend at Bernie's, you know. Natalie, are you there, Natalie? Natalie, if you're there, send me a question and say, why did you bring my name up? Okay. Fed should have raised rates 12 months ago. Now they're in a job destruction campaign, which sounds horrible. They're out there to try and reduce the number of people that are employed. It's in a job destruction campaign, but it's too late. The sugar, you can have a sugar high and a sugar crash. The economy is cooled and inflation is soon behind. The pig in the python is going to result in a blown out budget. We'll be left over with 29 trillion in debt and a higher cost of servicing that debt, which puts more pressure on the government to borrow more money. So what that means is that people are getting really pissed off at the Democrats, and they're going to vote in Republicans who will bring in tighter budget controls. And, you know, unfortunately, the Republicans have to do the unpopular work, and so they won't last, right? But they will. People are really pissed off at the Democrats right now. And, you know, I've been a bit frustrated that they do more politicking than than legislating. But Steve, what are you seeing on the polls right now for the upcoming election?
Yeah, well, for midterm elections, which are coming up in November in the US, the biggest determinant really in advance of the election is the sitting president's popularity, which is at the lowest level we have seen at this time in any other president's term in the last 100 years. He has a 30% approval rating, and it's still falling. So that suggests that the Republicans, barring some extraordinary event, will take at least the House of Representatives in November and probably the Senate. And as you know, the Senate right now, as it stands, is basically 50-50, with Kamala Harris, the vice president, playing the deciding vote on important issues. But yeah, it looks like the Republicans will take at least the House.
She seems to be ghosting America.
Well, if she's less popular than Biden, if you can imagine that.
But I mean, she seems to be ghosting, right? I mean,
Yeah,
You know what I mean by
they're
ghosting,
they're sort of keeping her.
well, they're keeping her, she's hyped.
Well, they're sort of keeping her out of the spotlight. However, she did do an event in New Orleans, in Louisiana, and the sign behind her misspelled Louisiana. Which just contributes to this notion that
What is his name? Oh, yeah, Paul,
Paul, get
you
it
want
back
to say,
here.
Paul, the problem is that we have a economy which I refer to as a pig in a python, where we've got this bulk of activity that is now going to disappear. So by borrowing $1.9 trillion and giving it away, what we see is consumers spending that money, and it's spent. And so now we're going to go into a recession. And so the Fed is so late in raising interest rates that is going to further cause the economy to go down more than it would otherwise just by the work off from the sugar high. So what we should see is a deeper recession than if the Fed had done nothing, well, obviously. But I think that the economy is going to be very weak, and that as a result of that, the Fed's going to have to reduce interest rates. And it's going to have to reduce interest rates also because it's going to put so much pressure on the US government to pay a higher rate of interest on the money that they borrowed. So is that help? Now, let me see what I'm getting. Okay, thanks. Is that Paul? Paul, is that okay?
Yes, it's okay.
Okay.
Joe, is that not business as usual for feds in the Western world? Like they're
that way.
renowned for too late and too hard.
No, I don't think so. I think when Trump was in office, he kept saying, come on, Fed, do something. Come on, Fed, do something. Come on. And he kept pushing him to do things, but there was this independence. And usually the Fed is more in tune with what the politicians are doing. And but right now they're at bigger odds than I've ever seen them. So in my experience, the Fed is, if I were Powell, I'd be really, really effing pissed off about it, because he's the one who's got to clean up the mess.
What they call transitory inflation, right?
But it's, yeah.
Lunatic, wasn't it?
Well, it was just much bigger transitory inflation than expected. So I do think it's transitory, but it is much, much bigger than expected. And but help me out, Steve. Bail me out, because that's a good comment.
Yeah, well, I mean, I think that the events in the Ukraine certainly didn't help. So the increase in oil prices were not anticipated. So that has made this transitory period a little longer than they anticipated. But with inflation, it can become self-fulfilling.
We settled the last meeting. Ukraine's not going away anytime soon.
No,
It's going to run and run and run. The Germans stop buying oil, Russians, everybody else, Central Europe, Western Europe.
and it's summer in
So
Europe
a
right
long,
now.
long haul.
Yeah, we'll really see the pain in the European winter when these gas lines are going to be offline for maintenance, is what the Russians have guided the market to expect. They're actually going to shut the lines down.
And I don't know if you realise that the whole area that he's already occupied is where the gas is. That's 100% of gas fields,
In
current
Ukraine.
and projected in Ukraine is all in that area.
So
He's
that,
annexed- that is the bit it's already annexed, it's the whole gas field place.
yeah, so this exogenous geopolitical event has made the transitory period in inflation a lot longer. And the problem with inflation is that from a psychology standpoint, if consumers start spending more because they anticipate it now, buying stuff now in anticipation of higher prices later, that just fuels greater inflation. And it's a negative feedback
But
cycle.
I'm saying that could flip on its head.
Of course it could, right, yeah.
And if prices start falling, people are gonna postpone purchases until things have come
Yeah.
down more. So that's really dangerous. So, and I think we could hit a deflationary risk in the
Yeah.
next year.
Yeah.
So there's a lot of risk in the market right now.
Yeah, and that's why the market's price where it is, 15 times earnings. When, I mean, if you look at Alphabet, for instance, which is trading at 13 times and 25% revenue growth expected. These prices, we haven't seen prices like this.
Okay, so how much are earnings estimates gonna come down? 5%?
Well, they're expected to go up.
No, earnings estimates. No, they gotta come down. This season, people will disappoint and estimates will come down.
Yeah, so we'll probably see a 5% decline.
So we'll see if that's a 5% increase in the P. So that means the P's, it's not really at 15, it's really 17.5, which, accounting for some risk, I think is fairly close to fair market value. I wouldn't say the market's dirt cheap right now.
Oh, I think some companies are doing.
Some companies are, yeah. But, the overall, I mean, Google, I think is a steal, and I think.
Dirt cheap. That is a dirt cheap company.
Okay. Thanks for bailing me out, Steve. Petrol. Okay, so petrol's going into transportation. So FedEx just reported earnings and they were pretty good. So petrol is not impacting FedEx, UPS, and some of the truckers as much as they may have. Plastic. Petrol goes into plastic and other industrial products. So there's a lot of inflation there. 6% in heating and power. Transportation costs are going to drive up the cost of buying petrol and will, as I said before, reduce discretionary expenditures. Here's a chart showing how oil is used into transportation, industrial, and into heating. This comes from the Department of Energy, U.S. Energy Information Administration. Labor costs are considered to be more sticky. So if you increase his wages, it's harder to reduce them, but they're more sticky in Victoria than they would be in the US. Certainly more sticky in California than it would be in New York. So it depends on what job you have. You have companies, as we talked about last month, unionizing. So we've got a unionized store at Apple in DC. We've got some Starbucks unionization. We've got some Amazon unionization. So that could be sticky, but they could come apart too. And when, as we've seen before, when there's unemployment, there are riots. So when poor people don't have jobs, you board up your windows, right? Here's a list of companies that have very low revenue per employee, or their employees are a large part of their expenses. Yum Brands, that's the China one. So that's only $26,000 in revenue per employee because people don't get paid much in China. But some of the companies here, you got a lot of people working at these IT consulting firms, Cognizant and Accenture, then Starbucks, and then FedEx has a lot of employees, IBM, retailers, TJX, Walmart, UPS, like FedEx, a lot of employees, Albertsons, Target. Raytheon was a real surprise to see in there. That is strange. So we've got to look closer at that one. But I looked at it and the numbers were right, but I didn't get into the detail on that, but it sounded very weird. Pepsi has a lot of people. That's surprising too. They're not like Coke. They don't just make syrup, right? They make potato chips too. Kroger, Amazon. So these are the companies that are more sensitive to the price increases. And we've seen some of these companies with some unionization issues. And so we're monitoring them for potential downside. On the bottom up, now we're going to get into the banks. Now, who's going to talk about banks? Yeah.
Thank you.
Yeah, so we'll preview the second quarter earnings for the stocks comprising the model portfolio, but also the sector. So banks fell 14% in the month, underperforming the market, with Visa a slight outperformer, and Goldman Sachs was in line. A report mid-month, and our focus will be the core Wall Street divisions, trading and investment banking. And we're starting to see some evidence that one of our macro themes, the virtuous cycle of very strong M&A activity, helped by cheap debt, which is less cheap, and rising equity prices. That theme will start to benefit Goldman Sachs less as we see rates normalizing. So we'll be closely looking at the impact that has, especially on the investment banking division, where Goldman Sachs commands a leading market share of about 28%. They're also diversifying the business into less volatile segments. So the markets, consumer digital bank, and their asset management businesses are both relatively capital light and serve to create overall more stable revenue profitability. And as always is the case with Goldman Sachs, they pay up for the best talent. So we'll be scrutinizing their costs, which are largely compensation.
So essentially, they just follow the whole sector.
This month, yes, in terms of stock performance, yeah, looks like good value, 7.5 times forecast earnings, and 2.7% dividend, which is relatively high.
But their sensitivity to net interest margins.
Yeah, so unlike, we like to distinguish Wall Street banks versus Main Street banks. The Main Street banks, which are more traditional deposit taking and lending institutions, they are more sensitive to rising interest rates or a steeper yield curve, because they pay depositors based on the short interest rate, short end of the yield curve, and they lend based on longer term interest rates. So as the yield curve steepens in anticipation of future rate rises, those banks experience what's called net interest margin expansion. So the difference between what they pay on a dollar of deposit and what they lend a dollar for expands. Goldman Sachs and the Wall Street style banks that have less of a lending business are less sensitive to a steepening yield curve. But it should be said that even though rates are rising, the yield curve has been very dynamic, and so it's not steepening. In fact, just in the last night, we actually saw an inversion again, as I mentioned earlier. So it's the slope of that yield curve which is most important to those Main Street banks. So in short, Goldman Sachs is not very sensitive to net interest margins. Consumer products.
Yeah, so consumer products and food have been very stable.
Stock prices relatively unchanged. So in a volatile market, they have fairly high PEs because their earnings are so dependable and so reliable. So we've seen Altria fall though, because there's some potential regulation, government regulation, where they want to take nicotine out of cigarettes. I think that, well, you laugh, but I think it's a great idea, you know?
But it ruins the point.
Yeah, that's the point. That's the point, you know, and somebody told me that a pack of cigarettes in Australia now is $50.
What?
Really? Somebody told me, is that right?
What?
$50. So they're making it illegal by pricing it out of the market, right? It used to be 5 when I was, first came here.
Yeah.
5 or 7 or something. And so, they're just making it illegal. You take the nicotine out, so Altria is down. Cardi, as Kelly already said, they're looking and smelling good. Okay, thank you.
Not a joke.
Influencers. General Mills had a great result despite higher grain costs. In media and entertainment, Paramount led the market down, which was very disappointing. There was no news on them, and they had that movie out, Top Gun Maverick. Has anyone seen it? Yeah, a couple of people, 1 or 2, yeah. And I've got Tom Cruise looked like he was,
You look great.
40 years old or something. I mean, really, you know, he's my age, right? He's 6 months younger than me. And he almost looks younger than me.
You get the same quality cameras on you, Joe.
Dish, okay, let's talk about Dish. I mean, there's some real risk there, right? And they're down 18%. They were looking interesting, but we lost interest after Chris did some analysis. So I think,
Yeah,
oh, Stephen, some analysis.
So Dish, you might know them. They were a satellite TV provider. That's really their legacy business. It is a company that is strategically transitioning to something else. In the last 10 years, they've spent $20 billion acquiring wireless spectrum in the US, and that wireless spectrum now is worth about $35 billion. So what happens is the US government sells licenses for certain bandwidths in the spectrum for communications that are used in mobile devices, et cetera. So they're building out this 5G network. They spent a lot of money doing that. It's a $10 billion market cap company with $23 billion in debt, and it's essentially priced at the net value of their spectrum, which is $35 billion if you cut out their debt. There's no accounting for the other businesses that they do have. So they still have about 10 million satellite television subscribers, which is a profitable business for them. They have acquired Sprint's prepaid phone business, which added about 11 million subscribers to a mobile phone service. So there's a lot of optionality in Dish. However, it's fallen 60% since October last year. But it's on our radar because it kind of looks interesting. It's
Well, when something falls 18%, I say why, and there's good reason why, right?
Yeah, but it's probably mispriced.
You think it's underpriced?
Yeah, I think that it's probably worth double its current stock value, which is $18 a share. So we would expect 36 or $40 a share. Probably what it's worth. Yeah, Paramount will report on August 4th. We're expecting 58 cents per share. Maverick was a massive success. Surprisingly, the market was not expecting it to grow. Well, it's now grossed over 600 million worldwide, and box office still continues to be pretty robust well into the summer months in the Northern Hemisphere. And they're gaining some ground with their streaming services. They have 67 million streaming subscribers. That's growing at about a 20% annualized rate. So they're getting some traction there. It's priced at 11.7 times earnings. So it's great value. And they continue to grow profits by about 10% annually. Very clean business.
One of the little exercises Steve and I did this week was to say, where could the US government get more money? And of course, religions are tax-free. And, and I was thinking that Tom Cruise and Scientology, now Ron Hubbard said, you want to get rich, start a religion. But there's a lot to be said for that if you have the right ethics, but a lot of people don't, right? So a lot of these are just scams. But we looked at the tax filing requirements and the income that religions make, and it's a serious business. You know, I think it would be good if has anyone ever been out to the Archbishop's house over here on the other side of Treasury Gardens? You know the big, is it the Archbishop's house? The one right next to the Freemasons? That's a big piece of land, right? That land alone's got to be worth $100 million, right? Okay, so let's not go too much into religion. Next, I'm going to have animals up here performing, animals and children. Who said I'd never perform with animals and children? Was that
WC Fields.
W.C. Fields? Yeah. And he used to joke he couldn't chew gum and walk at the same time too. He was a funny guy. Right? Activision Blizzard. You want to talk about that one? It's just doing its job for us, right?
Yeah,
It didn't
Activision
go
Blizzard.
down, right? It's doing its job.
That's right. We bought this as a specific event-driven investment. It is being acquired by Microsoft for $95 per share cash, with a very large break fee if the deal falls apart for whatever reason, about 4.5% of the market cap. Right now, it's trading at $78 per share, which gives us about 20% return in 12 months when the deal is expected to close in January or June of 2023. So this is a merger arbitrage investment, which is the type of investment we think is more defensible in this market environment. And it has done what we expected it to do, which was remain stable in a pretty volatile period.
So what's the discount?
Well, there's about 21% upside.
So make 21% a year. That's not bad. I mean, or it's 11 months now, right?
Yeah.
It's-
I mean, of course,
it's hard to pass up that deal.
yes. Now, the pricing suggests there's some uncertainty among investors as to whether the deal will complete, clearly, but it looks pretty probable to us. And
The break fee was how much?
3 billion. Oh, yeah, 2 billion, which is about 3.5% of the current market capitalization, which is about the biggest break fee we've ever seen.
It's going ahead. I mean, I remember that when they came out and, when this deal first came out, there was talk about Lena Khan and how that, they're going to stop. It's the biggest merger ever. There's a very low barrier to entry for gaming. People can create games, and it's something where Microsoft is not in that business already. So it shouldn't be any problem at all getting this deal through. And Warren Buffett agrees with us. He's bought a big position in it too. So pharmaceuticals, Viatris underperformed a little bit. Moderna beat, it rose this month in the down market. And then Illumina, they do this testing. So if you want to go and, go to ancestry.com and test your DNA to see what your history is like, the price of that is just collapsing because it's becoming more and more efficient. And so they're too good for their own good because the price is falling. So their revenue's falling, so their profit's falling. And if you want to get a DNA test, it's pretty cheap now. So they are down. Hospitals and devices fell. We sold Medtronic at its high, and it's down about 30% from where we sold it, 35%. Boston Scientific fell a lot this month. Intuitive Surgical, which we invested in and made a lot of money out over the years. But some of and HCA, the biggest hospital company, HCA stands for Get This Hospital Corporation of America. And they have a lot of hospitals. They were down. So there are probably some opportunities in Boston Scientific, but we didn't make a transaction this month, recommended transaction. Viatris.
Thanks, Joe. Expected to report early August. We're looking at the revenue and cost synergies from the merger of the two predecessor businesses, which were renamed Viatris about 12 months ago. And we would also expect that they'll benefit from a swing in political power towards the Republicans. This has been perpetually undervalued. This stock's trading at less than 4 times free cash flow estimates and paying a 4.5% dividend with a very shareholder-friendly dividend payout policy. So we've been paid while we wait. Moderna, also reporting early August. Most of the focus among analysts and investors is the robustness of their COVID vaccine revenues, which are proving to be more robust than most had anticipated because the new variants creating an opportunity to tweak the vaccine and sell more. But also beyond that, with the COVID vaccine is what we view as a test case for their mRNA technology platform, which they've developed over about a decade. And it's sort of like a proof of concept, which now we would expect Moderna to commercialize some of their other about 23 medicines that are in various stages of development. So we'll also be looking at progress on that front. The company is in great financial shape, having enjoyed and still enjoying windfall free cash flow and profits from the Spikevax. They have more than $9 billion in net cash, which will help fund the advancement of some of these other medicines. And they trade at very attractive multiples of forecast earnings and free cash flow. Joe?
I think we just got a couple of minutes. So we got 5 minutes. So retailers have a January year end because December is their busy period. So they all delay and have a year end that's a little bit later. So we saw downgrades in the retailers last month and the month before because there was some excess inventory at Walmart, at Target, and the other companies. So there's less going on in retail. They took big hits last year, but this month Gap and Target Gap down 35% as they had a delay getting into that. Housing's the weakest sector, and the internet stocks is one of those sectors that had been very weak because people were selling high growth stocks in anticipation of higher interest rates. But now what we've got is Alibaba up on an increase in earnings estimates and a roll forward. Spotify is benefiting, as Kristen spoke about earlier, about more proprietary content and a lower churn rate. And so their earnings estimates are up and they're doing well. Etsy is up and down. I mean, they're a horrible business, I think. But the difference between Etsy and Shopify, just very quickly, Etsy provides a platform for people to sell things, but you sell things next to everybody else. Shopify gives you a custom website that allows you to sell stuff and use credit cards through your own website. So the difference would be like going into Chadstone and having a Land's End store there or whatever store there, or going into David Jones and having 5 different brands with their own different departments within one store. So it's kind of like that difference in theme. And Etsy, if you don't continue to promote your product within, comparable to other stores, and you go on holiday, then you disappear and it's hard to get back. So that's the difference between Etsy and Shopify, basically, but it's for people who want to sell their own stuff, right? Shopify is vulnerable, Etsy is vulnerable, if you ask me, but we're very confident in Alphabet.
So Alphabet will report at the end of the month. And we're expecting $26.57 a share. They continue to maintain their dominant position for online ads. Worldwide, they have about 70% market share, and that has been consistent for years now. If you consider their cash position, which on a net basis is about $100 billion, they're trading at 13.6 times earnings, which, given their growth rates of 20 to 30% in revenue and even more in profit growth, that is a steal, in our opinion. That's the lowest multiple we've seen Alphabet at since we bought in 2015.
Semiconductors are horrible. So this is, to build a fab plant, it's going to be a couple of $2 billion, and fewer people build fab plants. More people now just design the chips. So there's a big separation in owning fab plants, and then what Taiwan Semiconductor does is contract manufacturing. But the capital expenditure just in designing chips is expensive too, and it takes a real unique, very, very detailed attention to detail skill set. So it's not easy to just start making chips, but it is very cyclical, because once you commit to making this stuff, you're either going to be short or you're going to have too much capacity or not enough capacity, and your prices swing radically. Now, Micron Technology makes the memory chips. So there's hundreds of chips. Qualcomm makes the modems, Intel makes the central processing unit, and Micron makes the memory, and there are lots and lots and lots and lots of chip companies. But look out, it's very cyclical. Micron down 33% on disappointment last week, which is in what we've been seeing in chips. I was floored by this, because we've been talking about shortages in chips. Auto companies can't make cars because they can't get chips to put in, every window or every mirror, everything's got a chip in your car now, right? So the car companies have to postpone, and then Qualcomm can't make enough chips to sell to other providers like the RF, whatever it is. RF.
Radio frequency. Yeah, so they prioritize the higher margin, higher value.
So there's a big shortage of chips. Now suddenly you got a big excess of chips. So Micron says, instead of doing 9 billion in sales next quarter, we're going to do 7. It's a shock. It's a real shock, right? So prices are turning. The broad application across the economy, good. Micron's a good barometer of the sector as a whole, but they do sell to computers. So Dell, Hewlett Packard, Lenovo, we're going to see falling demand there, falling demand from phones. So this is the one area of the market that has not been hit, and that's Apple. I mean, we've been talking, a year ago, that the FANGs, the top 5 stocks, are 25% of the market, and that's a large percentage of the overall market. And we've seen Meta platforms tank, we've seen Netflix tank, and we've seen Amazon tank. Google's been solid and Apple's been really solid. So Apple at 2.4 billion, if they can't make phones and you have a disappointment, they could come off the perch. So that I would say Apple is a vulnerability in the market. And if they're saying that they're not selling the phone makers, well, is it Xiaomi? Right? Is that how you say it? How do you say the phone company in China?
Oh, yeah, Xiaomi.
Xiaomi. So I say Xiaomi because Xiaomi is just my American way of remembering. You say Xiaomi? Xiaomi. Okay, glad we got to you, John. Major things affecting the chip industry is national interests. So you want to make your own food, you want to make your own cars so you can make tanks, right? You want to have certain manufacturing things that are domestic in case you got to go to war, so you have independence. Now the major independent, we got to have chip independence. So you've got US foundries with Intel, you've got Asian foundries with Samsung, and you have Taiwan Semiconductors stuck in the middle of the ocean, and everybody wants to control Taiwan Semiconductor.
Doesn't Taiwan produce 80% of the world's chips?
Is it 80%? That wouldn't surprise me, a big number. But now governments are coming out, like the US government has a CHIP Act, which is saying we're going to encourage manufacturing locally. And it's not the same thing as that stuff that happened up in
That's
Green
why
Bay.
China wants Taiwan.
Wasn't Foxconn going to do a whole bunch of stuff up near some lake in Minnesota or Green Bay or something? Lacine. So they are building big fab plants. They're committed to building big fab plants in America, and people want chip independence. Okay, cost to build a fab plant is really high, and the rate of obsolescence is pretty high too. So when you build that, it's like a general contractor puts up a building, but you have all these subcontractors which will do very, very expensive things. And I won't go into all the details of how the chip's made right now, but there are a lot of real special tool makers, and you've got to constantly upgrade that technology. US, and does anyone here know Moore's Law, just to get the audience talking a little bit? What is Moore's Law, Richard? You know, Moore came out of Fairchild, right? He did, he came out of Fairchild, right? Back in 1972. But what is Moore's Law? What did he say? The number of semiconductors on a chip will double every 2 years, right?
Yes.
And he's been right, right? Sorry to put you on the spot there. So, but he's been right, and you keep doubling and doubling, so you go down from lower and lower microns, so you go from 10 to 5, and now 3 micron, micron, and but that's a very small thing, right? So, so it changes quickly. And then there's the separation of fabs from designers. So you don't have Intel owning its own fab plant. They just design it and get it made by foundry companies. So Apple's trying to make their own chips now to compete with Qualcomm, and it hasn't worked out. So Qualcomm.
Qualcomm will report on the 27th of July. We're expecting $2.89 per share. Year over year, that would represent a 78% growth rate in earnings per share. So just massive growth in the last 12 months at Qualcomm. And this is really a reflection of their dominance in the rollout of 5G technology, their chips, and technological licenses in all 5G phones that are being manufactured worldwide. Benefits Qualcomm basically only. They're the dominant player in the West, at least, because Huawei, which is another competitor in 5G, has been locked out of the market in the Western world. They have a very important relationship, or have had a very important relationship with Apple over the years. You might call it a hate-hate relationship. Apple, for about 5 years, refused to pay the royalties and licensing fees on the technology that Qualcomm owns. In the end, Qualcomm prevailed. In 2019, Apple started paying them again. They had a settlement, but Apple made the strategic decision to start making chips and modems in-house and cut Qualcomm out completely. But it looks like that development has failed so far. So the relationship continues, at least for another year or so. So Qualcomm has rallied on that news in the last. But at less than 10 times earnings, with 38% revenue growth projected for this upcoming 12-month period, this is another steal.
Yeah, and with 5G, they're doing really well, so let's skip Boeing and finish up. We're gonna take it home, Steve.
Sure. Okay, we'll
Bears
take it
move
home.
on.
So here is the 10 stock relative value portfolio. We're quite proud of our long-term track record. It's been a rocky start to the year, but that happens sometimes.
By conviction.
Yeah, we're sticking with it. If you have a sufficient time horizon, hang in there.
Yeah, well, we went to cash for a little while and then we went to Activision, and that represents our conservative view on the market overall, right?
And we'll open it up for questions if you'd like to stick around.
Steve, what's your birthday?
May the 4th. Be with you.
I thought I'd start
Yeah.
watching.
Quick question for Joe. If your assumption of a rate cut,
If I what?
if your assumption of a rate cut needs to be delayed, how would it change your view?
You mean if we're not gonna cut rates?
Yeah.
Yeah.
Pushes things out 6 months. I think we're headed towards a deeper recession. The higher interest rates had a big impact on the growth stock. So what you could end up with is, potentially some recovery in the growth stocks now that at least we're seeing a base. So people start buying growth again because of the discounted cash flow analysis, the higher or lower interest rates. The higher rates create concern, but the lower interest rates were. So really the question is, what if they don't raise rates? What if they don't cut rates? Is that the question? What if they don't cut?
Or
rates?
they delay
Or they delay the cut? Well, if they delay the cut, nothing happens. Because that's what people think is going to happen. Right? So I'm the only one saying they're going to cut. So I would say buy growth.
Literally, you are the only one.
Well, I am the only one. No, it was.
But I think
It
it's
did come out on
a
the
very
market, though.
insightful point.
No, it did come out on the market.
Did it? Oh,
Yeah, it was in Daybreak today.
okay.
People started saying cuts. So nothing will happen.
But does the US have the same inflationary pressures that anecdotally are going on in Australia? I mean, we're starting to see some tips of the iceberg, particularly in the building industry. I mean, I've got
Well, I don't think
clients
it's
in
tip of
that.
the iceberg, is it? Did we have 4 bankruptcies over the weekend
Yep.
in the building sector?
Yeah.
Yeah.
And
So,
that,
and
that
it's because
pipeline's
they can't
still
get,
coming.
and they can't get product.
Correct.
So if they can't get product, you got supply chain problems, and they're getting washers, that they're getting taps and pipes from overseas. I mean, we're not making PVC pipes here, right? So Masco puts together, does Bunnings have supply? They have the stuff that people need to make some, I don't know. I mean, I don't follow the Australian market, but I don't know that, I would assume Australia is just. as bad as-
I guess my question was, there are some apocryphal stories coming out of the construction industry. Example, a very large development now being held up for 5 weeks because they can't get the orange conduit.
Well,
5
okay.
weeks on
Okay,
that,
so-
and it's $100,000 a week, the cost
So
of the
why
outlay.
can't somebody just bribe?
Can't what?
Facilitating
Sorry, did I
payment.
say that? Why does somebody just bribe their inverse? You take a bribe, doesn't it?
It is at the same sort of force.
I think so. I don't know what the Australian market is doing, but that makes sense in a general sense. You can't get pipes, can't get PVC
Yeah.
piping.
And you can't get labor.
And you can't get
Labor,
labor,
material,
and you can't get the light switches.
energy.
And a lot of that comes from China, and, boats are still backed up at Long Beach, right? So, yeah, I suspect it's a supply chain issue and an interest rate issue.
And the Victorian government have just given $30 million to Metricon.
Why would they do that?
Problem up, it's the second largest builder of houses in
Why
the
would
state.
they do that?
Please try and finish the project.
Oh, no. So,
Taxpayers-
sorry, you can tell I'm a free market guy. I'm a capitalist.
The taxpayers have contributed 30 million to prop Metricon.
That was nice of us.
Christian Bayer, this Monsanto Roundup issue,
Yeah.
you're saying here that
It's baked in. Now, we had a big surprise when the stock took a little hit last month on a case out of California, which will be appealed, but that is really, really baked in. So we're not concerned about Roundup and lawsuits over cancer and all that stuff. This is really about, they have this ugly history of buying Monsanto and having this ugly history of litigation, but it is history, and it is still hanging around the stock, and it's starting to evaporate. And that's why, one of the reasons we own. Okay, would you agree with that?
Yeah, and certainly a part of our thesis was this worldwide food shortage, which we're facing or maybe currently in. Their product improves the productivity of arable fields, and that's exactly what we need. So their crop sciences division, which accounts for about 43% of overall revenue, is growing at a 30+% clip. So at, again, a sub 10 times earnings multiple with a 3.6% dividend yield, this looks like a pretty good buy.
And you can't get out of this stuff. I mean, once you start using genetically modified seeds and Roundup that's resistant to the genetically modified seeds, and you reduce your crops, your space between your plants, you can't just stop using it. I mean, it becomes a dependence. So it's a sticky product. Ethically, people might have problems with that, but it's a sticky product.
But you know, the flip side of the ethical question is, hey, they're producing more food for the world to eat, and the world population is growing rapidly every year. So we need Monsanto or Roundup or glyphosate.
It's probably not as dangerous if it's actually used correctly, not like guys on the back of a truck, you know, not wearing masks and not
No,
wearing.
that I would have no idea about, but I suspect that there's probably, you know, safety precautions in Australia that prevent people from getting sick.
Now.
Yeah.
But they weren't when they were using it.
Yeah,
decades
yeah,
ago.
you would know better than me.
Okay.
Thank you very much for your.
Thanks, Doug.